Hello, Rob Lambert here with AssetProtectionTraining.com. Today I'm going to talk about family limited partnerships, some of the nuts and bolts about how to form one, what does the document that forms it even look like, where should you go, just a little bit on that, not too much on it, what does a typical agreement look like. I'm going to give you a 30,000 foot overview. We're not going to get into the details of multiple partners, business purpose, the relatively new cases, giving you some comfort that certain types of family limited partnerships actually will survive attack. We're not going to go into the many cases that allow family limited partnerships to be easily torn apart. Not going to talk about that now. Just going to deal with what's it look like, how do you form it, what are the tricks. Let's start with a typical LP1 that we use to form the partnership. This is a form called an LP1. It's pretty much the same in all 50 states. Some are a little more complicated than others. This one happens to be from Delaware. Delaware is by far my favorite jurisdiction, by the way. It has super laws. The laws are really flexible. They allow remarkable flexibility and the ability to do things that you can't get away with in other states. Like you can have, by statute, 0 ownership with the general partner and 100% ownership with the limited partner, often asset protection trust. That's just one of hundreds of unique things in their laws. There's no secret that all the Fortune 500 companies try to go there if they can. And I usually do, because in most cases the simple act of holding property for investment is not a trade or business, and in most states you're not required to qualify to do business. Places like California, New York, and many of the other states try to impose huge fees, close to $1,000 a year, forcing you to take out-of-state companies and qualify them to do business. It normally isn't necessary. Oftentimes the rubber meets the road when you go in to open a bank account, and the person at, say, Wells Fargo says, well, if you want to open a bank account for a Delaware partnership in California, you're going to have to qualify to do business and pay not Uncle Sam, I guess it's now Jerry Brown, close to $1,000 a year for the right to do business in California. I just tell my clients to get up and walk out of the bank, walk to the next bank, the bank next door. Could even be another Wells Fargo. Eventually they'll take your money, because unless you're actually engaged in a trade or business, you normally don't need to qualify. That's something you should talk over with a lawyer, because there are some repercussions if you don't, particularly if you get sued. Normally they're not too relevant to my clients. Anyway, this is a sample family limited partnership, LP1. I called the partnership sample FLP, that's the name, and all you need to do on most FLPs is give the name, the address of the agent for service of process, that you can see that in paragraph 2 of this, the name of the general partner of the partnership, and it usually needs to be signed by the general partner. That is all. That's filed, and normally normal fees are between mid-4s to mid-5s, depending upon how fancy of a kit you want to get. I usually use a company called Corporate Creations that's owned by one of my former law students. He's built it to the number 3 company formation company in the United States. They guarantee to beat anybody and everybody's prices. If you call and mention Rob Lambert at Asset Protection Training, they will take good care of you. If they don't, I want to hear about it, because they will hear from me. And they will beat everybody's price. I think I already said that. So this is a typical thing that you file to form a partnership. Don't think it takes a lot of art to do it. You don't need to pay some lawyer $5,000 to do this type of thing. In fact, in most cases, most law firms will simply call a company like Corporate Creations and have them form the entity, put together a fancy set of often leather-bound books, send those out. The lawyer puts them together or has his or her secretary or paralegal organize it. You give it to your client and you charge them $2,500 or $5,000 along with a standard form agreement. Kind of something you don't really need to give your lawyer a lot of money to do. However, there are some very significant decisions that you will need to make along the process, and we'll touch on some of them today. Anyway, this is a typical LP1, and you'll find that it's downloadable like the agreement I'm about to show you. It's downloadable below. Now I'm going to take a look at a typical limited partnership agreement. We named this partnership Sample FLP. Stupid name, but it made the form kind of easy. And let's take a look at its table of contents. What it does is it just organizes your behavior. The operating agreement, the partnership agreement that you're looking at, is basically a list of rules that you agree to be bound by as the partner, general partner and limited partner. And you've got intense amounts of flexibility. All I care about when people do partnership agreements, when they're doing asset protection, is that they understand the rules and that the partnership agreement is really solidly put together, has all the business and tax provisions that might be necessary in the future, and basically works. It needs to look and feel and act proper. The fundamentals, the formalities are not as intense as with a corporation, but it's still very important that you follow the rules, and that's what the partnership agreement does. Let's look at it. First section is organization. I'm going to show you these little provisions, but here we have term. If you're putting your partnership with a asset protection trust, they both should be roughly the same term. In fact, they both should be the same term. It has definitions you can see in Article 2. It has stuff about partnership capital. This actual agreement is written so that you can actually have multiple limited partners, and it has something called 704(b)(2) provisions. That's not that important to most asset protection folks, but it means you can go into business with your, you can go into business, form a donut shop, you put up the money, and your other partner does all the work. He might be the general partner, you might be the limited, and you can structure it so you get all the tax benefits and all the, say, cash flow until you've gotten your original investment back. Then you can split the cash flow and the tax benefits differently to allow the other partner to have a payback. That's called 704(b)(2) provisions. Not critical, but I almost always include them because they don't hurt anybody. Financial. This just talks about the, as you can see, paragraph 4, the accounting methods, the fiscal year. Talks about management. Who manages the partnership? Well, you'll see when I scroll through management, it's basically 100% managed by the general partner. There are very few, if anything, that's important, nothing really with the operation. There's very few things that the limited partners have any voice on. That's why I love limited partnerships, because by statute, the limited partners don't have a lot of power, and they don't have enough power to put themselves in a position where they're vulnerable to easy reach by an aggrieved somebody who thinks they've been harmed by the partnership. Limited partners have such limited authority, it's hard to maintain that they created, that they did a tort, that they violated a contract. That's always the general partner. That's always the managers. That is not the limited partners. And here, paragraph 6, limited partners, look, they have no management control. I'm going to get to these in just a second. Books and records, very important. Don't get sloppy. Never treat either your trust or your partnerships or any of your LLCs as your alter ego. Remember, this is a separate, brand new baby. This may be your first baby, and you don't want to treat your baby as your pocketbook. This partnership and the related asset protection trust, if you choose to do it, and this agreement's perfectly fine to do without an asset protection trust. You can have human beings or companies as the partners. It just doesn't work very well from an asset protection point of view if you don't do that, in my mind. But it works. It does work, and it is designed that way. Let's take a look at it. The first page. I'm just going to read you the beginning so you can kind of see the stuff. This agreement of limited partnership is made and entered into as of a date by the general partner and the limited partners. That's all you need to form it. That does it. Just to keep things clean so your records are sensible. It talks about having a business purpose. It talks about the name. It talks about the term, which is in this case 60 years. You can go much longer, and there's oftentimes no reason not to go much longer than 60 years. Sometimes, in fact, more and more of my clients are asking for trusts that go for a large amount of time. It can save a teeny bit of taxes, but it mostly allows you to rule from the grave. I don't like people trying to do it because it's very hard to give them any confidence that they can successfully do it, but it's becoming more and more popular as people are getting less and less comfortable that both their heirs and their entities are going to be safe and sound. Faith in the government is rapidly falling apart. Definitions, these aren't really very important to you right now. You should read them, but they're all dealing with mostly tax consequences because of that thing I called 704B2. That's not something I'm going to talk about right now, but it is something that you might want to do a little reading up on. And certainly you can take this agreement and give it to your lawyer or whoever is helping you with your planning, and this will save them an awful lot of work. This is a good starting place. This agreement has been reviewed by hundreds and hundreds of law firms, and it's just a simple, straightforward document. It deals with capital accounts, and you actually need to maintain capital accounts. Not something you actually do yourself, but you need to maintain records so that your CPA can tell you what the magnitude of your capital account is when necessary to dissolve or make distributions from the partnership. All those distributions have to have what we call substantial economic effect. Again, beyond the scope of this lesson, but normally not an issue when you're doing asset protection. I'm just throwing things that you can talk with your advisor about. It's quite important. The financial side is basically almost always a cash basis calendar year taxpayer. There's a lot of stuff about allocating net income and chargebacks. That is really irrelevant stuff to 99.9% of the people doing asset protection. But I'll tell you what, by putting it in there, you sure make your agreement look and feel good. And sometimes the appearances of reality are just as important as the reality. Paragraph 5 is important. This deals with the management. And basically read the first paragraph of 5.1. The operations and affairs of the partnership shall be administered by the general partner, who shall have all authority, right, and powers conferred by law, etc. The real important thing is the limited partner has no authority. By the way, look at all, they're here. There's an effort to identify some of the powers that the general partner has. It goes on and on. Responsibilities of the general partner, limitations of the general partner, basically he can't steal, and compensation, says the general 5.4 says the general partner can get paid. This is all just standard stuff. You can do it almost any way you want. You have a huge amount of flexibility. Any good lawyer and indeed any good asset protection person will be able to give you your options and show you how you can do your options. Now here, 6.1, that's important. The limited partners shall not be bound by or be personally liable for the expenses, liabilities, or obligations of the partnership. Now I want to cram this into your head one more time. If you decide to combine a family limited partnership with an asset protection trust, the asset protection trust should be the limited partner. Usually and often a 99% limited partner, sometimes 100%, sometimes 80%. There's no hard and fast rule. But this limited partner trust, where your savings are, where your money you're going to rely upon if your whole world falls apart exists and resides. This limited partner trust shall not be bound by, this is 6.1, not be bound by or be personally liable for the expenses, liability, or obligations of the partnership. Look at 6.2. Limited partners shall take no part in or interfere in any manner with the control, conduct, or operation of the partnership. Period. Bottom line. And you can read 6.3, kind of not too important, but the limited partners have the right to vote and have a voice on a few things like converting a limited partner into a general partner, or alters the interests of a general partner, or affects the status of the partnership as a partnership. That's D. These are not relevant in most cases. It very seldom happens, but it's very important that you all realize that the limited partner really is not likely to be successfully named and then held responsible for the actions of the partnership itself. The entity, the person that is responsible will almost always, really I could say always, be the general partner. 7 has some transfer of interest restrictions. All of these are pretty standard. You'll see them in all sorts of different types of agreements. It talks about records in 8.1, inspection, reports. 9 deals with dissolution. These are all standard. They don't really require a lot of explanation, but your agreement should have all of this stuff in it. Not because you think you're even going to need it, but it should have all this stuff in it so that if somebody decides they're going to try to invalidate your partnership, you're at least starting with a good agreement, and you've done a proper bank account, and you've kept proper records and observed all the formalities required. That is a big deal. You don't live off the money in the partnership. It's money that is for a business purpose. It's also part of your savings that you're holding for a rainy day. It's not money you put in every week and take out every week. I'm just going to keep flipping through. 12. Article 12 is just miscellaneous things. You can execute it in counterparts. It's binding on the successors. Choice of law. Normally, the choice of law will be the state in which you reside, even though it's a Delaware partnership. That's it. Look, this is 18 pages, and only about 3 pages are really necessary. The rest of it is all there to make it feel good and look good. And again, all you need is a general partner signature right up here and a limited partner signature right here. And the general partner can be a human, it can be a company, and the limited partner can be an offshore trustee. It can have a United States co-trustee. That would be if you had a kinetic trust where you were involved as co-trustee. That's probably unwise for most of you, but there's plenty of options. And this is a darn good agreement to start with. I hope that this is helpful to you. Download it, look it over, and there will be a large number of additional videos dealing with the nuances, but get the basic flavor of what an agreement looks like into your head. It'll help you with the vocabulary, and it'll help you with your comfort. Thank you very much.